Right, members. I still sound a little bit croaky. This is Subcommittee on Financial Institutions Resolution, Loss Absorbing Capacity Requirements, Banking Sector Rules, and this is the first meeting. We have attained the quorum. Let's elect the chairman, Mr. Dennis Kwok, and nominally Mr. Chen Zhenying, seconder. Mr. Chen Kim-bo seconds Mr. Chen. Accept the nomination? Yes, I do. Thank you. Right, a valid nomination. Any further nominations, please? By the count of 5. 1, 2, 3, 4, 5. Mr. Chen, I hand you over to Mr. Chen. Do we see the need for a vice chairman? No? All right, then shall we invite the administration in, please? I'd like to welcome Ms. Estrella Chung, PAS, FSTB, Mr. Robert Probin, Senior Manager, HKMA, Ms. Carmen Chu, Senior Government Counsel, DOJ. The paper has been issued to members. I don't think we need to have a very detailed presentation. Will the administration spend about 5 to 6 minutes taking us through the framework? There are lots of technical details, and then members would then take the floor to put questions. Ms. Chung, please. Chairman, thank you. But time is limited. Perhaps I defer to the Hong Kong IMA to brief members on the rules because it is the Hong Kong IMA who formulated the rules. Mr. Probin, please.
Thank you. So I will just make a brief presentation on the background and substance of the rules. So just very briefly up front, what is the purpose of these rules? These rules will promote financial stability and depositor protection in Hong Kong. The failure of certain banks could pose risks to the Hong Kong financial system and therefore the wider economy, and potentially cut off depositors from their money. These rules will require banks to issue a new type of debt to investors that could be written off or converted into equity if the bank runs into trouble. Removing debt from the bank's balance sheet is able to restore it to financial health by imposing losses on investors. This allows the bank to continue to perform critical financial functions and protects depositors' funds. I'm now going to give a very brief overview of the Hong Kong resolution regime and the background to these rules. So the international context for the development of resolution standards internationally was the global financial crisis, which saw systemically important financial institutions fail and have to receive taxpayer-funded bailouts in order to avoid severe adverse financial stability implications. The Financial Stability Board, of which Hong Kong is a member, was mandated by G20 leaders to address this problem, and this led to the development of international standards. The Financial Institutions Resolution Ordinance was enacted by the Legislative Council in Hong Kong in June 2016, And this establishes a regime for the resolution of financial institutions that is aligned with the international standards developed by the Financial Stability Board. The legislation I just referred to, the FIRO, establishes a regime that covers the banking sector, the insurance sector, and also the securities and futures sector. And the ordinance, the FIRO, identifies the relevant authorities for each of those sectors as the resolution authority that, should an entity under its purview fail, would assume responsibility for managing the orderly failure in a way that protects financial stability. The FIRO does this by providing the resolution authorities, which for banking sector entities, including authorized institutions, is the monetary authority. It provides them with the power to apply stabilization options, in particular the bail-in stabilization option, which allows the resolution authority to write off or convert into equity certain liabilities on a bank's balance sheet, and also transfer stabilization options, which allow for the resolution authority to transfer certain assets and liabilities of a failing bank to a third party. Very briefly then, a policy rationale specifically for these rules. The bail-in stabilization option works by allowing the resolution authority to, as I explained, write down or convert into equity certain liabilities of a bank, and in so doing, recapitalize the institution without recourse to public funds. However, certain types of liabilities are more suited to being bailed in than others. Like, for example, subordinated unsecured debt can in particular be bailed in more easily. So the purpose of these rules is to ensure that authorized institutions have sufficient stock of liabilities that can be readily bailed in, i.e. sufficient loss-absorbing capacity or lack. So having sufficient lack is a prerequisite then for an authorized institution to be able to be resolved should it fail in an orderly way that preserves financial stability and protects access to critical financial functions, including including the deposit-taking facilities enjoyed by ordinary depositors. So facilitating the orderly resolution will protect those depositors and the broader provision of financial functions by banks to the wider economy. I'm now just going to move on to consider very briefly a few of the details in the rules. So the rules will allow the monetary authority as resolution authority for authorized institutions to classify an AI or certain group companies of an authorized institution as a resolution entity under these rules. Resolution entities under the rules are then required to meet minimum external lack requirements by issuing these loss-absorbing capacity debt instruments to entities outside the group of the relevant bank. The rules will also allow the monetary authority to classify a bank or certain group companies of the bank as a material subsidiary where that entity is part of a wider banking group. And should that happen, material subsidiaries would be required under the rules to issue these loss-absorbing capacity debt instruments internally within the banking group, thereby meeting an internal lack requirement. Under the rules, the external lack requirement to be met by a resolution entity is calibrated at twice the minimum regulatory capital requirements. The internal lack requirement to be met by material subsidiaries is calibrated as if the material subsidiary were a resolution entity, but scaled at in between 75 and 100%. These calibrations are set out in the rules, but the monetary authority under the rules would have a power of variation to vary the precise calibrations where necessary to reflect institution-specific circumstances. There's also a minimum debt requirement under the rules to require a minimum proportion, 1/3, of an authorized institution's LAC requirement to be met with debt instruments rather than equity. The other couple of points of detail it will be helpful to bring out here is that the timeline for implementation, as set out in the rules, is 24 months after a resolution entity or material subsidiary has been classified by the MA, subject to where the rules promulgated by the Financial Stability Board specifies a shorter timeline for a global systemically important bank, then under the rules, any such entity would have to meet a LAC requirement within 3 months. And finally, because these LAC debt instruments provided for in the rules are designed to boost the loss-absorbing capacity of banks, they are therefore at risk of incurring loss should a bank fail, and are therefore unsuitable for investment by ordinary retail investors. So under the rules, issuance will be limited to professional investors only, and they must be in a minimum denomination of $2 million in order to further limit their appeal to investors who may not properly understand or be able to bear the loss. Thank you.
Okay. Introduction. I'll now open the floor for our members to raise questions first. But before that, I think I need to declare once again my role as the consultant of BOC Hong Kong, licensed bank here in Hong Kong. 頭先有三
Well, a moment ago, there were 3 members who raised their hands, Mr. Jeffrey Lam, Mr. James Toh, and Mr. Dennis Kwok, and then Mr. Kenneth Leung and Mr. Chen Kin Po. I'm not going to limit your time. Mr. Jeffrey Lam first, please. Chairman, thank you. I read the paper. There are many questions that the administration ought to respond. First of all, you've conducted a consultation. After the consultation, the document seems differ from before the consultation. I've heard a lot of views from the banking sector, the SMEs, and they've got a lot of comments, and a lot of their comments have not been taken on board. This resolution ordinance, the intention is in connection with the systemically important institutions. There is a resolution system. In the event of non-viability, the impact on the financial system will be mitigated as a result of a resolution mechanism. Now, from the paper, all the banks seem to be included, including the small size banks. Now here, the financial institutions included would include the banks, the insurance sector, the equity and futures sector are also included. What is the government's intention? Is the government's intention to cover the banks only, or is it the government's intention to extend this to other financial institutions? I've heard views from the SMEs that
for large, systematically important banks, it was a basic tenet of the new Basel III regulations that large, systematically important banks with complex international operations need to bear higher levels of capital to protect against the greater risk they present to the operation of the financial system. The small banks individually have very small market share of less than 2% in Hong Kong banking market, whether measured in terms of total asset, loan or deposit, and none of them perform critically functions which, by virtue of their failure, would put the operation of Hong Kong banking system at risk. They are therefore not considered systematically important, nor would their failure pose risk to the stability and affecting working of financial system of Hong Kong. Also, all these measures would also increase their operation costs. That would not increase their competitiveness, but in result, hurt their competitiveness against the bigger banks. So, Chairman, so I would like the government or MA to answer my above questions.
OK，唔該晒林議員。係啊，張秘書長你。
Thank you. Ms. Zhang, would you be answering the question? Yes, first of all, in terms of the scope and coverage, and then the Hong Kong MA will answer the question concerning the consultation of the banking sector. First of all, this law is indeed applicable to banks and securities firms and also insurance entities. However, the rules that we are talking about is actually formulated by the Banking Commission for the banking sector. We consider the Hong Kong financial system stability, the scale, and all these other things. The banking sector would first of all have to have this rule in the area of LAC. Now, as for other areas, such as the consultation of the banking sector, perhaps the Hong Kong MA can answer that question.
So, on the consultation process, there was an original consultation paper launched in January, to which we responded, and then another consultation process in July, to which we again responded. And over the course of the process, there were some amendments made to reflect consultation responses. To pick up, though, on the particular point of emphasis in the question about the applicability of these rules to potentially small and medium-sized banks. The primary legislation, the FIRO, is expressly designed to cover, expressly covers all authorized institutions within the banking sector. And so the LAC rules themselves, these rules also potentially cover a wider range of authorized institutions that are likely to necessarily be subject to LAC requirements. So under the rules, the monetary authority is able to classify as a resolution entity or material subsidiary only institutions incorporated in Hong Kong, and in practice will only be able to classify as resolution entities or material subsidiaries those entities that, on failure, would be anticipated to be put into resolution under the primary legislation, the FIRO. And in order to be put into legislation under the FIRO, there are a number of conditions that have to be met, including the condition that the failure of the entity in question would pose a risk to financial stability in Hong Kong, including to the continued performance of critical financial functions. So what this means is that in the circumstances where there is a very small AI, the failure of which would clearly not pose any risk to financial stability, and where the failure of which would not threaten the continued performance of critical financial functions, then that entity could not be put into resolution under the FIRO, and equally could not be classified as a resolution entity or material subsidiary by the monetary authority under these rules. So while the terms of the rules are cast fairly broadly to make sure the monetary authority does have the power to impose LAC requirements where they are needed, the intention is not to apply requirements unless an entity on failure would be considered likely to pose a risk to financial stability.
Chairman, I'd like to suggest, since I received many comments from the banks and financial institutions, especially the smaller banks, actually I think maybe it's prudent for us to invite them to come here and we listen to them once more and to get a straightforward answer from the authorities.
Okay, that means you think deputation will be required for us to listen to the industry's opinion before we, further deliberate the rules, right?
I think it's as I said, it's prudent, and I think it's necessary for us to hear the views from the concerned institutions.
Okay, thank you. Jeffrey, do you have any follow-up question?
Jeffrey?
The HKMA representative, Robert?
It will take me a whole day, I think.
Okay,
I'll come
so
up.
let me turn to James. You can raise your question now. Thanks.
Testing. Okay. Sorry, for my voice. I believe more question for my colleague for their whole day. And I just ask a more simple question and on this first meeting. Hopefully, my voice will change better to the next meeting. Okay. Well, I understand. First, from the first question, that certain banking entity, well, to say not big enough to pose systematic risk to the financial system, may not be called on under this mechanism. Well, when my colleague just have a small talk during my colleague Jeffrey asking, of course, we are thinking about there may be at least several in our mind. But I think, of course, I don't want to, I'm not have a specific view on those smaller banks. But can we know roughly, up till now, how many of, well, in the current situation, okay, how many entities out of all the banks we are talking about, which may not be big enough to have systematic risk? That's number one. Number two, well, is it if those are bigger banks, okay, which may impose a systematic risk to the financial system, okay, you want their shareholder or the supporters, okay, or the shareholders, basically, have the standby fund or a commitment or a guarantee in case of need to issue those new debts, which may be, well, eventually converted into a losable equity. Okay. Well, I'm asking the amount, let's say, in this current situation, when I'm the ultimate shareholder, controlling shareholder, will I know now that what's the amount at the current situation, take into account my equity, the market cap of my bank, the debt, and the involvement of my bank in the system? Will I know how much I should have this kind of standby debt to be issued once you trigger the mechanism? Or under, what mechanism that I will know until I have time to prepare for my continual support of this bank? That means whenever you trigger this mechanism, I have to have the fund ready or within certain days to have sufficient capital to inject into the bank on this new debt. Okay. Well, is that all are very certain under the principal mechanism or under this secondary subsidiary legislation? Yeah.
Robert, please.
Sure. Thank you for your questions. I'll address them in turn. So the first question on kind of how many banks would be potentially covered by this piece of legislation. So there are of the order of, so the FARO, the primary legislation, covers all authorized institutions, of which there are approximately a couple of hundred in Hong Kong. It is clear from the rules that they will only apply, even potentially, to institutions that are potentially of importance to financial stability and that are also incorporated in Hong Kong. And if we look then at the number of licensed banks that are incorporated in Hong Kong, that reduces the number to 22 out of a couple of hundred or so. And on the same date in which these rules were...
sorry, one very small question. These 22, they know that they are one out of the 22, or that they may not know whether they are included, practically.
Sure.
Well, of course, a chairman's bank, his consultant post to that bank, of course, I'm very sure. But what the banks that refer to are my colleague, Jeffrey Lam. I don't know, maybe they are not included, but they are worried that because they do not know that they are included or not.
Sure.
James, I would like to clarify one point. These particular rules should be interpreted or read in conjunction with a code of practice to be issued by Hong Kong MA. Under that separate code of practice, they have some concrete numbers that identify yourself whether you will be coached by the LAC requirement. My understanding is that for general banking community in Hong Kong, only a few very small banks will be could be escaped from this requirement, just like a 3 bank. My understanding is only 3 banks that could be excluded from this requirement, and those 3 banks are pretty small in number. I don't know whether you want me to name them or not.
No, Chairman. Well, please, because
sure.
Please, because the government said it's 22 who may be affected. Okay, but you said
only 3
you're very sure
will be
that
excluded.
Well, no.
Yeah.
Well, I want to answer directly from the government.
Okay, sure.
Well, because because they will say, no, not just the 3, because the other 18, because other 100 odd, okay, may be potentially included. Of course, maybe 3 very safe, not included. But because they said 22, so that means that 22 and the other non-22 will be the dividing line.
Okay. If I could clarify, excuse the interruption. So the 22 are those that are potentially, on a reading of the LAC rules, could be in scope. And thank you for pointing out that we published a code of practice on the 19th of October, the same day the rules were gazetted, published a draft for consultation. And according to the proposals set out in that consultation draft, of those 22, a number would not be covered. So on the proposal put out in the draft, around about 17 of the 22 would potentially be within scope. But just to emphasize the point that this is according to a proposal put out in a consultation draft of a code of practice issued on the 19th of October.
Please continue with the other.
Yeah, the second question, to pick a bank, whether they know exact amount they need to issue.
Sure. So on that second question, the rules, as we saw in the brief presentation earlier, require that for a resolution entity, the starting point is that the LAC requirement is 2 times its regulatory minimum capital requirement, and that for a material subsidiary, so a part of a wider banking group, the requirement will be 2 times reduced by the so-called internal LAC scaler. So on a combined reading of the LAC rules and the consultation draft of the Code of Practice, it will be clear to AIs which ones are potentially in scope on the reading of the Code of Practice, which obviously remains in draft form. But just to clarify, there is in any case a timeline which is designed to ensure that once resolution entities and material subsidiaries are formally classified, and once LAC requirements are set on an institution-by-institution basis, that there will then be a further 24-month period for implementation. In the consultation conclusion that the HKMA published in July, we set out a planning assumption that, excluding for one moment global systemically important banks that will be required to meet LAC requirements sooner under FSB proposals. So excluding those, the planning assumption is that no other banks would be formally classified any earlier than the 1st of January 2020. So following then a 24-month implementation period as set out in the rules, no other banks could be required to start to meet LAC requirements any earlier than the 1st of January 2022.
Okay. James, if you don't mind, I will let Dennis to raise his question first, and then we'll come back to you later, okay? Dennis, please.
Thank you, Chairman. Thank you. I've got 3 specific questions. Number one, I note that the Financial Stability Board in the UK has issued similar LAC requirements. And in the proposal of the SFB, if I remember correctly, the LAC requirement has a range of around 16 to 22% of the risk-weighted assets as the TLAC requirement that they have imposed. Now, how does that compare with the requirement that we have under the present rules, which is the inner LAC scala of 75% to 100%? How does that compare with the requirement adopted by the Financial Stability Board? Because I'm not a banker, so I don't know how the 2 figures relate with each other. Are we safer? Are we requiring our banks to do more, or about the same, or less? That's number one. Number 2 is paragraph 14 of the paper. You said that for authorized institutions that are incorporated outside Hong Kong, you would also allow them to issue the LAC equivalent instruments. So what extra safeguards have you put in place to ensure that if these instruments are issued outside of Hong Kong, how do you ensure that they are legally enforceable? What extra measures would you require these AIs who are incorporated outside to satisfy you that the LAC that they've issued are of the same quality and of the same legal certainty as those issued in Hong Kong? For example, in the UK, I think they require a specific legal advice confirming that that particular LAC instrument issued in that other jurisdiction complies with the laws of that jurisdiction. So do we have something similar in place? Number 3 is, I think a similar question has been asked by my honorable friends, is whether we have done an impact assessment. In particular, once these rules are implemented, do we know what the impact assessment will be on the bank's ability to provide liquidity or credit to the market? How are they going to be, is it going to be make life much more difficult for them, or whether they can afford to continue to provide sufficient credit to the market? So 3 questions. Thank you, Chairman.
Thank you.
Okay, so
Robert?
thank you for your question. So taking them one at a time. So the first question asking about the extent to which the proposed calibration of LAC requirements under these rules compare with those under the Financial Stability Board's proposals. So the simple answer is that the proposed calibration is broadly the same. But whereas under the FSB's rules, there is a sort of a one-size-fits-all approach of, as you say, 16%, then rising to 18% of RWAs for all GSIBs. What we've done under the LAC rules is have a calibration that is driven off the existing capital requirements of an institution. And what this does is better reflect the particular characteristics of an institution in setting the LAC requirement. So if an institution is particularly safe, deemed particularly safe, and has a low capital requirement, it will then have a lower overall LAC requirement. If it is deemed to need a higher capital requirement, it will accordingly need a higher LAC requirement. So the numbers will, broadly speaking, be comparable to those proposed by the FSB, but they do a better job of capturing firm institution-specific idiosyncrasies and risks.
So we're more flexible, in other words.
Yes, you could put it that way. Yeah.
flexible in the sense that Hong Kong MA can have, a discretion on the implementation measures.
Yeah, so I guess flexible in both ways. Firstly, in that the calibration of LAC requirements, the starting point of the calibration of LAC requirements under the rules will reflect an institution's original capital requirements. So there's more flexibility there. And then the MA will also have discretion to vary that where appropriate in the context of the firm's particular circumstances.
Thank you.
So your second question about the issuance of LAC debt instruments outside Hong Kong. So this is contemplated under the LAC rules. Specifically in Schedules 1 and 2, there is a requirement that either instruments need to be governed by Hong Kong law, or if not, then appropriate reassurance needs to have been provided that if they are governed by the law of a different jurisdiction, then those instruments would still provide the same degree of loss-absorbing capacity, still provide the same amount of protection and the same amount of resource to the issuing bank.
So what is meant by appropriate measures? That, what would you how are you going to interpret that phrase or that requirement?
Yeah, so in the circumstances where, for example, an instrument was issued under a foreign law, then in those circumstances, the monetary authority, the resolution authority, would expect to see evidence of appropriate legal due diligence, for example, a legal opinion, and evidence that even though the instrument is governed by a foreign law, if need be, if that entity was to get into financial difficulties in Hong Kong, the resolution authority would still be able to access the resources represented by that instrument.
But that presumes that that foreign jurisdiction also has a similar FIRO legislative framework in place. But what if it comes from a jurisdiction where there's no such regulatory scheme in place, similar to the one we have in Hong Kong? Because you assume they also have a FIRO. So, for example, does PRC have a FIRO? And if so, who is the relevant authority there?
So you're right, there could be circumstances in which an authorized institution issues LAC instruments that are governed by the law of a foreign jurisdiction, and after having done appropriate legal due diligence, the conclusion is reached that actually we cannot safely rely on this instrument being able to absorb losses. And in those circumstances, that instrument would not count towards meeting the issuer's loss-absorbing capacity requirement.
Yeah. So if the foreign jurisdiction doesn't have a FIRO similar scheme in place, then most likely you will not accept that LAC instrument as meeting the safeguards.
So that could be the case, but it doesn't necessarily follow, because it could be that actually the other jurisdiction doesn't have a resolution regime like the FIRO in place, but there might be other aspects of the interaction between the laws of the two jurisdictions, which means that in any case, we can still be confident that the powers of the resolution authority could still be used. Because these instruments are still going to be issued by a legal entity that is incorporated in Hong Kong. So I think there could be circumstances in which, even if there wasn't a FIRO equivalent, we could still get an appropriate level of legal comfort.
I'm going to stop here, but this is my last point on this question too, is I'm most interested in the PRC situation, because we're so closely connected and there are so many PRC banks in Hong Kong. And if they have to issue LAC instruments based on PRC law, how would you look at these instruments and how would you regard them? You don't have to answer me now. You can save that for a later date. But I would be very interested in how you assessed PRC law govern LAC instruments, like
especially
this bank.
Yeah, especially my understanding that PRC will implement the same, in year 2025 instead of 2022 here in Hong Kong. So I think they need to explain to you more on the different place, how it's going to work if the two different jurisdictions have different implementation day.
Thank you, Chairman.
Okay, third question, please, Robert.
Sorry, the third
Impact
question.
assessment.
Third question.
Impact assessment on the liquidity of banks once implemented.
Yeah, sure. So we did do an impact assessment. The HKMA did do an impact assessment on the proposals set out in the rules. And this was included in full in the first consultation paper that we issued in January earlier this year. And that impact assessment was modelled on similar impact assessments that have been done in other jurisdictions and indeed by international bodies that have put forward proposals around TLAC and LAC and so forth in other jurisdictions. And what that impact assessment does is essentially look at the potentially increased costs for banks of having to meet LAC requirements and the benefits to the financial system and the economy in Hong Kong of having improved financial stability. And certainly for the, and while I, as is clear in the impact assessment we publish, it is hard to present it as an exact science. What the impact assessment does is establish a kind of a range of LAC requirements that clearly deliver an overall net positive benefit. And certainly the sorts of calibrations that are under consideration in the rules, in particular the 2 times capital requirements, is firmly within the range of requirements that, under the impact assessment, deliver a positive net benefit for the Hong Kong economy as a whole.
Okay.
Thank you.
Dennis, have you got your answer?
No, yeah.
Okay, now
Thank you.
then it's Kenneth's turn.
Thank you, Mr. Chairman. Robert, you mentioned that the tentative implementation date will be 2022. Can you clarify whether this is a date whereby the institutions has to meet all its LAC requirement, or you are just issuing the mandate and ask them to comply? Just first question first.
On that, our planning assumption is that, as I say, excluding the global systemically important banks, so for the other AIs, they would not be classified, formally classified, any earlier than 1st Jan 2020.
Okay.
And it would then be 24 months after that that the LAC requirements would have to be met. So those are the 2 earliest dates.
Yeah, okay. My second question. Okay, you are going to assess the significance and stability and the exposure of each individual authorized institutions when you require them to issue LAC. So the scenario would probably end up having different, quantum of LAC in each of those institutions. Am I correct in assuming so, right? Is that correct?
Yes, so the requirements will be calibrated by...
Calibrated, okay. But the calibration won't change the internal and external formula. Would that change the formula? Would the calibration include any change in the basic formula at all?
So no change in the basic formula, but the MA would be able to vary the requirements if there were additional characteristics of an institution which merited a variation.
Okay. And am I correct in also assuming that both the internal and external LAC requirement will have to be met by the institution at the same time? Is that correct?
Essentially, each institution will either be subject to an external LAC requirement or an internal LAC requirement.
Okay.
So you could have within one banking group, you could have one entity that is subject to an external LAC requirement and a separate entity that is subject to an internal LAC requirement.
Okay.
And it is likely that both of those would have to be met at the same time, but each institution would only have one or the other.
Okay. So how do you determine how many entities within the group should be meeting either the internal or external requirement? Are you using the same kind of assessment or risk assessment or decision criteria?
Mm-hmm. So in terms of establishing which entities should be classified as a resolution entity, this goes back to the question we were discussing earlier about it is only those entities whose failure could pose a risk to financial stability.
Right, okay.
In terms then of identifying a material subsidiary, there are some specific criteria set out in the rules as to which entities within a group could potentially be classified as a material subsidiary with reference to their size.
Okay. Just two more questions, Chairman. Sorry about this.
It's okay.
I understand that these LAC instruments are basically unsecured debts or subordinated debts. And one other characteristics of these instruments would be that upon certain event, these debts could be converted into equity. Is that the main characteristics of these LAC instruments in a nutshell?
Sure, they could be written off,
Written
just so
off?
the investor doesn't get their money back, or converted into equity, so replaced with ordinary shares.
Okay, fine. If that is the case, would there be any existing on-balance sheet instrument substantiated in the balance sheet of these institutions which already have met the LAC requirement, which they do not need to do anything by 2022 or 2 years after 2022? Would there be any institutions that could have met already those requirements at this present moment? I mean, I'm just asking a very naive question.
No, so
Not
the
really.
answer is that's absolutely right. So under the LAC rules, banks are already subject to capital requirements, and essentially most of the capital that banks already have that counts towards capital requirements will also count towards LAC requirements.
Okay. So this comes to my question. Why are, in accordance with my honorable colleague Jeffrey, there are quite a number of institutions which got concerned. Now, in the first place, I do think when the FIRA regime come into place, they are well aware that the LAC rule would be coming, right? This assumption should be correct, right?
So the FIRA...
When the FIRA rule has passed, yes, the LAC rule is coming. And some of these institutions would have had some sort of LAC-like or LAC instrument on their balance sheet. So why, the question is, I may ask the chairman or Elmer, why are these smaller institutions so concerned about the LAC rules? That's my question.
Robert, maybe you give your answer first. I can supplement after your answer.
Sure. So while it is the case that instruments that already count as capital towards meeting capital requirements will also count towards meeting LAC requirements, because for resolution entities, for example, LAC requirements will be calibrated at twice the amount of capital requirements.
Okay.
Some institutions, I'm sure, will be concerned that being subject to LAC means they have to issue more of these types of instruments.
Yeah.
So I think the nature of the instruments is less of a concern. It's more that they might have to issue a greater volume.
Yeah, Kenneth, I think two concerns. First concern is if, within a group, you need to issue LAC instrument to your parent company, but your parent company may not have the same requirement to issue LAC at this moment. Say they may, their parent company may require just to have a LAC requirement 3 or 4 years from now, even a bit later than Hong Kong. So that means, that LAC instrument that bought by their parent company will become a direct deduction from their capital base. Instead of they can issue an external LAC so as to pass through the risk to the market. This is first thing.
Okay.
The second thing is that for LAC paper or LAC instrument for smaller bank, they have to use a very attractive interest rate so that the market practitioner would consider to buy this kind of paper, because specifically bank or insurance company could not buy this kind of LAC paper, so the potential buyer will be quite limited. Say some hedge fund or some private banking customer that willing to accept higher risk. So that's the second concern from them, that you have limited buyer, potential buyer, to buy your LAC instrument, even though you want to issue something to the market.
Okay. One final question. Now I would leave the chance to my other colleagues. I understand that these LAC instruments will only be sold to professional investors as defined under the SFC rule. Is that correct? Okay. And it seems to me that once you got these LAC instruments, there is no no liquidity in it because there's no market in it because people are just holding on to it and receiving interest and bearing the risk. Is that correct?
Robert?
So I think there's nothing in the rules that would prevent a secondary market from developing in these instruments. It is, of course, the case that to the extent retail investors are not part of that market, it is perhaps smaller than it otherwise would be. But the alternative is to allow retail investors with access to these instruments and then run the risk of investors who are some combination of do not properly understand the risks and perhaps are unable to bear the loss, then being exposed to these instruments. And I think that risk is not something that we would want to run.
Okay.
Okay. Now it's the turn of Honorable KP Chen. KP, please.
主席，我想問一問幾個問題啦。第一就
I have a few questions, Chairman. Yes. First of all, declaration. I'm an independent non-executive director of the East Asian Bank. Thank you for reminding me, my colleagues. Thank you. I have a question. The Hong Kong MA categorizes an entity as a resolution entity. Only then will they have to do such work or do the preparation, otherwise not, right? So if a bank has gone into a resolution process, my question is, why would anyone bring out real money to buy the debts? So in the end, the instruments will be highly expensive. Can you perhaps think of the scenario that the bank would therefore die faster, and that is go into receivership even faster? The bank is so weak already. Otherwise, you have to price it very, very high. Otherwise, no one will be buying it. So is it really feasible and practical? That's my question.
Right, that if you get to the stage where a bank is running into difficulty, trying to raise funding at that stage is likely to be very expensive, if not impossible. So under the rules, the banks will be required, those banks that are affected, will be required to issue these lack debt instruments in advance. So this means that the instruments will be issued by financial institutions, banks, in a kind of business as usual scenario, so that should sometime in the future that bank run into trouble, the financial resources are already pre-positioned on its balance sheet. So thank you for raising it. This is a very important point, is that the rules require these lack debt instruments to be issued and for the necessary resources to be pre-positioned on the bank's balance sheets in advance of them getting into difficulties.
如果你咁講即係話其實平時已經要做定。
So that is to say, they will have to do it in advance. So they will have to do it before they run into trouble, not at the time of getting into trouble. That clarification is very important. Perhaps I should supplement. According to the rule, the FIRO, in ordinary times, the financial institutions will need to do certain planning. That is, before they run into any difficulty, there would already have been in place a strategy to be used where they run into trouble. And these measures are part of the procedure for internal resolution. Right, I know. So this is a new requirement of the banks. This is a new capital requirement for the banks. Basically, it amounts to that. And so for the banks, in the worst case scenario, perhaps they'll have to sell their headquarters, they'll have to liquidate certain assets. So how to get capital before final liquidation. This is what this is about. And further to this, I do not know how the banks in Hong Kong will operate in the future, because on the one hand, there will be virtual banks. There will be over, 10 or 20 licenses, so there will be fierce competition. And then now you have this And Hong Kong is one of the forerunners in implementing this mechanism. So is the banking sector competitive still, attractive still? Are you destroying this sector? How do they go about their business? What about Singapore? Singapore is not going to implement virtual banks. They're not going to issue virtual bank licenses.
The license. So there will be fierce competition in the banking industry in Hong Kong. And now you add all these capital requirements, which is so huge. As you just mentioned, it's 15 to 18% of the asset. You know how big is the amount? So I'm wondering, have we ever considered, whether the bank can survive at all? So why are we creating such a difficult situation for Hong Kong banks? Have you ever considered whether they can survive after you really do all this to them? And you are requiring so fast. You are actually one of the first regime in the world to be imposing that kind of requirements. So I would really urge, first of all, we must have a hearing from the banks. As one of our colleagues has already, we need to hear from them. Secondly, I'm really worried about those, no matter it's big, medium to small, they all have big problems. If you're trying to impose this without, considering what are the financial impact to them, they could be a killer to the banks in Hong Kong. At least those that invest in bank share would have a big problem, because you will see the earning coming down very fast, because you have to issue all these debts in advance. So it is crazy, because when I posed you my question, I was hoping that you would say that, only when they get into trouble, then you will ask them to issue this. But you are not. You are going to ask them when they have a CAR ratio of 19% in average, which is much, much higher than the basic requirement, and you're still doing this. And then what you are doing this actually increasing their CAR ratio to 30%. So it is totally crazy, isn't it? So please really think about, what we are doing in the insurance industry is that under the laws in Hong Kong, the latest insurance law, the insurance authorities not only required to regulate the insurance, they also need to promote the industry so that the industry can survive. Otherwise, we don't need any regulator at all. You'll probably lose your job if all the banks are bankrupt. So what I'm trying to say that is please really think about whether it's viable, whether it's practical to impose such a high level of capital in addition to this so high level of liquidity in the banks and also capital, everything is so high. So please really consider whether they can survive.
張秘書長，我覺得陳議員嘅問題咧係比較宏觀嘅，我覺得。
Mr. Chan's question is more macro, I would say. Before the Hong Kong MA answers his question, I would like to ask the Policy Bureau, how do you respond to Mr. Chan's question just now? And then the Hong Kong MA can answer the specific questions. Well, thank you very much, Chair and Mr. Chan, for the question. Of course, we very much value the voices of the industry. If the chair believes that there should be a deposition at the LegCo, then we will be happy to come to the deposition and listen to the banking sector. The Hong Kong MA colleague had introduced to us just now, even though we understand that there will be certain impact to the banking sector, but overall, for the stability of the financial system, the positive influence is also something that we should have regard for. Now, in the 2 rounds of consultation, the responses we have collected so far, there were not too many problems with the overall regulatory structure, but rather just on some of the details. So we will be looking into these specific opinions. Robert, do you have any response?
Honourable KP Chan's queries.
Sure. So thank you for the question. So I was going to talk about the impact assessments, but that's already been covered off. Thank you. So I think one thing I would like to bring out, though, is that these are to some extent new requirements, but these have been very much in train and in contemplation since the primary legislation was enacted in 2016 and then came into force last year. So the FIRO specifically provides for the making by the monetary authority of these rules. So obviously new today, but they have been in train for quite a while. And just to make a couple of comments on the international context. So Hong Kong is obviously one of the most prominent global international financial centres. And as such, it is important that Hong Kong is able to provide both a robust regulatory environment for financial institutions, but also financial stability. And so if you look around at other international financial centres, both in the UK, in the US, in other jurisdictions that are host to the world's biggest banks, they are all either have already or in the process of bringing into force rules that are comparable to these LAC rules to ensure that when banks fail, they are able to do so safely, protecting financial stability, and without putting at risk depositors' funds and the ability of the banks to continue to provide critical financial functions. So on one level, it's fair to say that Hong Kong is moving forward with these rules, with a limited number of other jurisdictions at the moment, but those jurisdictions are exactly our peers in the sense that they host globally important international financial centres. And the view of the MA is that these rules will in fact complement and increase Hong Kong's standing as an international financial centre. And as we've heard during the consultation process, the responses from industry were largely that they were supportive of a resolution regime, and they were supportive of having a LAC regime. Obviously, there were some comments and differences of opinion about the implementation details, exactly the scope of calibration and scope of banks that should be caught and so on. But the principles, we believe, have widespread support.
主席，你唔好介意，我再跟進啦。即係我只係想講，
I'm going to follow up.
係啊，阿張秘書
助理。
Well, Principal Assistant Secretary, I think we have to be careful. The banks may not dare say the truth to you. Now, they haven't seen the details, the guidelines that have just been issued. Like, it would be a big difference between 100 million and $1 billion that they have to set aside. The fund will be lying idle, and this will add to their costs significantly. When the banks come before us, that they've written to us quite a lot, and I'm not suggesting any particular bank will experience trouble. I think you have to be careful with the details. The ratio is very high. Now, can you tell us when will Singapore bring this into operation? I think we have to compare ourselves with our competitors. Will they have the same calibration, or will they have the same threshold?
The global standard. So we need to do that. There's no choice at all. But the problem is, how fast are we running? Are we going to run ahead of everyone so that we are leading everyone, or we are trying to impose something so heavy that no one can sustainable? So why don't we wait for other big countries, global countries, to go ahead first, and then we see what are their problems? Just like Solvency II, you look at Euro, they impose the Solvency II, and there's so much problem that they really can't do it anymore. So they are now changing, and many places in Europe still not imposing Solvency II. And then you see there are other systems like the risk-based capital, which are much better than Solvency II. So I'm worried that may be another copy, another version of the Solvency II, which has created so much problem. So please, while I fully understand where you are coming from, but please really take my advice. It could be very dangerous or harmful to Hong Kong. We really don't, you and I live in Hong Kong, so we don't want to hurt Hong Kong at all. So why can't we at least be a little bit slower than Singapore? Can we do that? So that is basically my my question and hopefully advice to you.
So without wanting to comment on the specific future plans of the Monetary Authority of Singapore, what I would do is make the observation that what we're doing by bringing these rules forward now and then setting out an implementation timeline, which as described will run several years into the future, does not by any means put us as a distant kind of outlier front-running everyone else in the region, never mind around the world. For example, Japan is the host of some of the world's biggest banks and has rules in place doing this already. Singapore and Australia are both taking forward proposals along these lines, reflecting the need for banks that fail to have adequate loss-absorbing capacity on their balance sheets to protect public funds. The biggest banks in China, in the mainland China, will also be subject to TLAC requirements in due course in the coming years. And it's likely that, notwithstanding that under the Financial Stability Board's rules, the Chinese banks were given an additional number of years to comply. It's likely that in practice, when those rules come into force, in order to allow for an appropriate implementation timeline, that there may not be that big a difference in timing there either. So I don't want to give the impression that what we are doing is front-running wildly other jurisdictions in Asia, never mind, as I've already mentioned, in UK, Europe, in the US. What we are trying to do is set out clearly, well in advance, proposals and these rules to ensure that the industry here in Hong Kong has an adequate transition period in order to adjust, in order to meet these requirements, which will enhance financial stability in Hong Kong and protect the provision of critical financial services to the wider economy.
Chairman, 我想再
Well, Chairman, I've got two suggestions, if I may. I think, first of all, there are banks that have high capitalization ratio, and they should be included first. And the other thing is the government should consider conducting some studies. Now, for large shareholders, it would be easy, but if they don't have large shareholders, it would be very difficult for them. That we're not talking about a small amount of money, maybe billions and billions of dollars. I think you have to work out the details. If you plunge into this, it would be difficult. The interest rate is hiking up. There may be a financial crisis. I think you have to consider asking some experts or some actuaries to work out the range of costs that would be added to the banks. Well, Robert and Ms. Cheung, Mr. Chen is basically asking the administration to consider using part of the CAR and convert it into LAC. I don't think the paper is addressing this issue specifically. The other thing is for the banks or FIs that don't have any one single large shareholders, they have to issue these instruments. Have you considered the costs that will be incurred for these FIs? Have you conducted any studies? Do you have any information for members? Well, as a matter of fact, Robert, if possible, I hope that the government can give us a tabulated chart showing us Singapore, Japan, and some neighboring jurisdictions in Asia, and the pacing of the implementation of the LAC requirements. I know from Robert that some are moving more slowly than Hong Kong. They're doing the consultation. Can you give us a chart showing the different paces of different jurisdictions with regard to the LAC rules? That way, we would know in Asia what are the paces for the jurisdictions in Asia. All right, next, Dennis.
主席，
Chairman, thank you. I think the issues raised by members are practical policy issues.
The situation in China, that my understanding is of the 4 major banks, there is a need to raise roughly $1 trillion worth of TLAC product amongst the 4 banks, just amongst the 4 banks, $1 trillion, much higher than Europe, much higher than the US. So, you know, speaking as an outsider, Chairman, if I may, if there is a demand for China to raise $1 trillion worth of TLAC assets or instruments, how are we going to sell? How are we going to expect our banks in Hong Kong to sell their TLAC instruments to who? Who would buy it? Because when China is already eating up so much of the funds available on TLAC instruments, $1 trillion, I think there is a legitimate concern that maybe the banks in Hong Kong won't be able to sell this to anyone. Who would buy it? It's my question, and I think it's a worthwhile question, one raised by my honourable friends. So have you considered whether they can actually do it by 2020?
2022.
2022. I think China, PRC is doing it much slower because I think they realize they have a huge problem of meeting that $1 trillion gap. And so they want to wait and see how these TLAC instruments will actually do before fully implementing their TLAC requirements. Do we need to do it at a much slower pace, given that's the situation? Thank you, Chairman.
Thank you.
Just to make a couple of observations in relation to that. So, as already described, putting to one side the global systemically important banks, for other banks that might be covered by LAC requirements, the earliest likely date by which requirements will need to be met is the 1st of January 2022. But a couple of points to make in relation to that is that is 24 months after classification. And the date of classification for any particular entity would be determined by the monetary authority. And while the rules provide for a 24-month implementation period, that can be extended by the monetary authority. So while it may well be that actually the investor base for LAC instruments issued by a Hong Kong bank is not in any case necessarily the same as the investor base for Chinese GSIBs. If there are concerns about market capacity at the time at which Hong Kong banks are issuing these types of instruments, there is flexibility in the rules to allow for timing to be suitably arranged to avoid any glut of instruments coming to market, which the market would then struggle to absorb. And I think it's also important to make the point that of the banks potentially in scope in Hong Kong, the clear majority are subsidiaries of overseas banking groups. And so they are more likely to be classified as material subsidiaries rather than resolution entities, which means they themselves, the Hong Kong institutions, would be issuing internal LAC within their groups, and then the parent banks would be funding that through the issuance of external loss-absorbing capacity instruments into global capital markets, in which many of these parent banks are already established names.
Dennis? Okay. Kenneth? No. Thank you.
Talking about the return on this LAC instrument, I don't know whether there would be any research or estimate or any business analysis. How many basis points would you think would these LAC instrument to be paying in order to become attractive? Because probably I think these LAC instruments will not be credit rated. I think what yardstick we need to compare would be AAA debts. And how many basis points about a normal AAA debt will these LAC be paying? That will be the cost of capital to the banks. I don't know whether there will be any study on that, because I think my honourable colleague, gone already, would be interested. And my second question would be, many of my colleagues have asked about once the LAC's been issued and the banks got the funds into the balance sheet. Now, it seems to me that these funds will be sitting idle because you can't make use of these funds to do lending. Is that correct, or is that a requirement? What are they going to do with this fund when they get into their vote? Is it just sitting there on the balance sheet doing nothing, or can they use the fund to do some sort of very safe lending? And what, in fact, do they require to do when they receive these funds from the LAC instrument?
Thank you for those questions. So on your first question about the cost of these instruments and sort of basis points. So there are a number of global banks that issue instruments, TLAC instruments already, but of course none based in Hong Kong. So when we did our impact assessment, what we assumed was that the cost of LAC instruments issued by Hong Kong institutions would be the same as some of the capital instruments that Hong Kong banks already do issue. So we have quite a good kind of data point there, which provides us with a guide as to how these LAC instruments might be priced in due course. And in fact, we took quite a conservative approach in our impact assessment, because we would expect these LAC debt instruments to rank senior to any capital and therefore be less risky and so be a little bit cheaper. And so when doing our assessment, by assuming they would be priced the same as some of these capital instruments, that was actually quite a conservative assumption. So that's one sort of a significant data point we've used in doing the modelling. I'm sorry, can you...
Second question.
Sorry, could you remind me of your second question?
Is there any regulation whereby you are allowed or not allowed to use the fund raised from the LAC instrument? Are they sitting in the balance sheet, idling away, or can you lend out a percentage of that fund you got, or what? What can the bank do with the buffer here?
Yeah. Sure, apologies. So there are no restrictions set out in the rules on how a bank could apply the funds that it raises through issuing LAC debt. So in practice, subject to normal supervision and the bank's normal business, there is nothing to prevent a bank from taking the proceeds from LAC debt issuance and using them to fund its normal productive portfolio of investments and lending activities.
Yeah. Okay. Okay. 咁我作為主席就
As the chair, I will ask three more macro questions. Hopefully, Ms. Cheung can answer the questions. First of all, for FIRO, it applies to three different types of financial institutions: securities, insurance, and banking. And there are three different regulators. They are the insurance regulator, the SFC, and the Hong Kong MA. These three regulators, the question is, how would they implement LAC? Have they been communicating with each other? And as far as I know, the Hong Kong MA is leading the way. And in this instance, the three's coordination, how would that work? That's the first question. Secondly, we all know that the trade war between China and the US may be ongoing. Even though there is some amelioration, next year, the year after, and a couple of years after, Hong Kong's economy may well be affected by this trade war, and there will be operation stress. Now, the regulators are coming out with these international standards and implementing these international practices. Have they taken into account the stress or pressure of the bank's operation reality? Would there be any grace period or buffer, for instance, 3 months, 6 months, 9 months grace period for each of the items so that the banks can have a bit more space before full implementation? Another question concerning LAC, and that is the Hong Kong MA issued Code of Practice. It is mentioned in there which banks, big or small, will have to comply with LAC. And it seems that 150 billion as capital is a cutting point. How often will you review this threshold, please? Well, after the issuance of the Code of Practice, will there be regular review as to the threshold? Because we do have inflation every year, and let's say we set the threshold 20 years ago, given 2 to 3% inflation per year, you will have to review the threshold at a certain time. So does the authority or the Hong Kong MA have a commitment for review regularly, so that this threshold will be appropriate for the prevailing situation and economic situation? Thank you, Chair, for the 3 questions. I will take them in turn. First of all, for the financial institutions, that is for FIRO, it is true that there are 3 categories of financial institutions which will be regulated, and they are the banking sector, the insurance sector, and also securities and futures entities. The 3 sectors each have their own regulator for FIRO, and under ordinary circumstances, in handling the FIRO within the sector, then the regulator for that particular sector will be the RA. But where it is cross-sector, then the financial secretary will have to, in that instance, well, let's say there is a financial group with different categories of entities, then the financial secretary will appoint a particular RA to handle that particular banking group. And we've done that for banking groups. As for LAC, this is only applicable to the banking sector. I've mentioned this just now. And we believe that the banking sector should take the lead, because internationally, SFB also had issued the banking guidelines, but not for the other 2 sectors. We do not have that yet. As for the second question, in the next couple of years, whether there will be unforeseeable situations or instability in the operation environment of banks, and therefore there should be some flexibility to the implementation date. Well, basically, the date of first implementation is already flexible. Under the LAC, the RA should, according to each financial institution, have a certain plan. If there is indeed need for internal adjustment, then this entity, this financial entity, can be classified as a LAC necessary entity. And from then appointment on, counting 24 months, the institution can do or make the preparations. And because the process goes from one FI to the next, therefore, from the Hong Kong MA's point of view, they, of course, would have a priority. And for the local financial system, whichever banks will have the certain impact, of course, they will prioritize those first. So are you saying that there will be a priority according to the size, from big then to small? Is that what you're saying? There will be prioritization according to importance or impact on the financial system. And if an FI is defined as or designated as having to comply with LAC, then the FI would be given 2 years to do so. And there are other flexibility in terms of timing. That's the first point. Second point, the banking sector instability in the future. Well, given that, shouldn't we prepare early, so that if indeed there should be difficulties, then this mechanism would kick into place and be functional? And that is exactly the purpose of setting this mechanism up. Thirdly, concerning the LAC requirement, the Hong Kong MA had issued a code of practice, the consultation period of which has not completed yet. Now, if there are certain details on the code of practice, we're welcome. The Hong Kong MA would welcome such opinions, and it would end on around the end of October or November. All right, any other questions? There are some documents which will be submitted. First of all, the Asian countries that are implementing LAC and what the situation is for these countries, and provide that after the meeting. And secondly, whether car conversion to LAC, do you have some studies to provide us for information, please? And thirdly, where a bank does not have a single controlling shareholder, then in issuing LAC instruments, have you done any analysis on the cost and feasibility? Is it feasible actually? Because this rule, when it is commissioned, it will become a rule. So the banks would have to consider whether it is indeed feasible to comply. So if you will just provide us with that those documents or information, that would be good. And just now, members had said that we should have a deputation to invite the banks to come voice their opinions. Mr. Sheikh, are you in agreement? Yes, if you are, I am. Thank you. Well, we'll find a time and conduct that session, and we will gather the opinions. And because today we are not going clause by clause, we'll wait for the deposition, and after that, we will have the clause by clause after hearing the voices of the banking sector. If there are no further questions, we will close the meeting here. Thank you very much for your participation. See you next time. Thank you.